So I was introduced with a very, very fancy background. And on the first day of my career at McKinsey, I was taught about something called the 80-20 rule, which all of you know about, that 20% of your clients contribute 80% of your revenue. You should spend 80% of your time doing that. The first story I'm going to tell you is about how I did exactly the opposite when I started my career. The year was 2006. I was a glamorous hedge fund manager at AQR, as someone pointed out in my introduction. And times were very, very good on Wall Street. Markets were at a high. Nobody thought anything could go wrong. And bonuses were great. As hedge fund managers, we thought we'd never needed to take any advice from anybody when managing our personal finances. So bonuses came along in 2006 and 7, and I decided to invest all my savings, every last rupee of it, in stocks, emerging and developed stocks. I went crazy deciding कि मैं कौन से ब्राज़ील फंड में कितना पैसा डालूं और कौन से चाइना फंड में कितना पैसा डालूं और कौन से साउथ अमेरिकन फंड में कितना पैसा डालूं, and 100% of my money went into stocks. Then the apocalypse called 2008 happened. My personal portfolio was down 30-40%. And in March 2009, I had to move to India to start the business called Forefront Capital. What is the mistake I made? I spend 80, maybe 90% of my time selecting funds and 0% of my time on my asset allocation. Even by your conventional wisdom, which says that 100 minus your age should be your asset allocation, maybe I was 25 at that point, so I should have been 75% invested in equities. But my situation was even more unique. I was a financial services professional working in a hedge fund, so my career was entirely dependent on equities. In 2008, my personal portfolio was down 40%, bonuses went to zero, and also I was married to someone in the same industry, so everything collapsed in one go. So that was experience one of asset allocation, and I have never repeated it. Thankfully, after that exercise, I read somewhere that 90% of the value in investing comes from asset allocation and 10% comes from everything else. My second story is about learning the power of simplicity. I moved back to India in 2009 to start a boutique AIF and PMS business called Forefront Capital. Again, when you have this fancy Wharton degree and all these qualifications, you believe that every product you create must be tremendously complex. I mean, investments का अगर rocket science है ना, तो वो करके दिखाने का हमें वो था. So we did everything to create very, very complex investment products. And like with anything that is too complex, nobody bought it. In 2010, a distant friend of mine who was starting an e-commerce company in South India came to me and said he wanted to work with us. But he said, Radhika, yaar, everything you do, I don't understand. I want something very basic in life. I want to earn an inflation plus 3-4% return, something like 11 to 12% on an after-tax basis, and I don't want stress in life. Also, I want something very, very simple. And we said, simple, yeah? Why are you coming to someone with all this fancy background for something simple? One of my partners resisted, and since we couldn't do anything else, we launched what was a smart asset allocation solutions PMS. We took 4 basic asset classes: large cap equities, fixed income, gold, and international equities. We found mutual funds in each of these, and we decided to allocate some money to all of these asset classes. When market conditions were more dynamic, we changed the allocation to each of those asset classes, and we held all of these at all points in time. That client invested 10 lakhs with us. It's year 2016, and I just left that business last month to take over on AMC, but that individual client is now 250 crores in a single fund. All my complex products have died a long death. But if you look at that client's experience, he has returned over this period 11% post-tax and post-fees in a period where markets are up about 5% year on year, gold is up about 6%, fixed income must be up 7, 8 or 9%. He's very, very happy. And what was really powerful is we started in Jan 2011. Now you remember 2011 was a period where markets were down 25%. It was also a year where gold was up 32% in rupee terms because it was a very tumultuous period for the economy. This was his only portfolio because of the diversification that he held that was actually up 9% in a year where markets were down 25%. He was a fan for life. And what's more interesting than his outcome is how he's evolved as a client. You don't go from 10 lakhs to 250 crores overnight. Obviously, he's been a huge success as an entrepreneur. When he started, all his questions to me were, कौन से फंड में इन्वेस्ट करोगे? अच्छा, इसका डायनामिक फंड या इसका बैलेंस्ड फंड या ये फोकस्ड फंड? I can tell you today, he doesn't even know what funds he holds. All he knows is what his asset allocation is. We have a quarterly review, and even the reporting is focused on his asset allocation. As he's grown from a 10 lakh customer to a 10 crore customer, the discussions are how to amend that asset allocation. Should we add more alternative assets? How are his life goals changing? But the discussions are never about funds. That exercise and that mental shift has happened. Is asset allocation an art or is it a science? I think there's no right formula, but like most things in life, when art and science meet, it's a very, very heady combination. I'll share 4 points of a very simple 4-point process that's worked for us. The first is to pick your universe, and I'm sharing these in order of importance. Hold a diversified universe. 50% stocks and 50% bonds is not a diversified asset allocation. 90% of your portfolio's risk is coming from stocks. Try at least 4 asset classes. In global asset allocation portfolios, कम से कम 20 asset classes होती हैं. 4 तो शुरू करो. Indian equities, fixed income, which is accrual and duration, and gold and international equities. I met someone who had given the Robo Advisor presentation, just a few minutes ago, and he said the only thing that has really worked, the big thing that has worked for them, is the fact that he had these 2 asset classes. Yet when you go to a client, they'll be like, gold kyun hold kar rahe ho? It's a hedge against inflation, and note it's a hedge against a falling currency. Why hold international equities when India is doing so well? Again, it's a hedge against currency. If you look at the history of asset classes, no one can predict with certainty what asset class is going to do well in a particular year. In 2009, the best performing asset class was what? Indian equities, mid-cap equities specifically. In 2013, what do you think it was? It was actually global equities. Last year, it was duration. Holding a little bit of everything in static state actually solves quite a bit of your problem. The second is to come up, after you've decided your universe, with a base allocation that works for clients. And this is where art comes in. People say, how do you come up with a base allocation? You have to know your client's risk-return profile. I don't think any client will tell you, mera ye risk-return profile hai. What has worked for us, at least, is that take a spreadsheet and run through scenarios with people. I think as an advisor, when you talk to people and show them over 15 years, if I held 25, 25, 25, 25 in each of these 4 asset classes, the maximum you would lose is this much. The worst quarter you would have is this. The kind of return you would have is this. You can see someone's risk-return profile on their face. And that's where art and science come together. By the way, just holding 25, 25, 25, 25 in these 4 asset classes that I mentioned over the last 10 years would have given you a portfolio return of 10, 11% on an after-tax, after-fees basis without a single negative year. That's in a period where even the Nifty has only compounded at 13%. It's not such a bad outcome. It's an easy outcome with a lot of peace. The third step, once you've decided your universe and come up with a base, okay, it's 40 large caps, 40 fixed income, 10 international, 10 gold, is to use markets to vary that allocation a little efficiently. And there are 10 ways you can vary this allocation. Some people have made a complete science out of this. What I would say is be counter-cyclical. Just by varying the allocation 10%, in my example of 25, 25, 25, 25, that gives you an 11% portfolio return. If you can just sensibly vary your allocations by 10% a year correctly, you can add an incremental delta of 2 to 2.5% year on year to your client's portfolio. That's a pretty large number. Be counter-cyclical. A simple approach is compare all these asset classes on a value basis. Are large caps attractive versus mid caps? Are they attractive versus international equities? Are they attractive versus the yield on fixed income? And allocate to these asset classes. And the fourth one, and I say this despite being an MF CEO, in least order of importance is choose the funds. Once you've decided the asset allocation, choose the funds. 90% of your problem is taken care of by the time you've reached this stage. Fund selection should be a very, very simple process. For each of the 4 asset classes that you've got, just define an objective. For large caps, that objective could be, I just want funds that can deliver Nifty plus 5% year on year with high consistency. For mid caps, that objective could be, I want funds that take high alpha, that really are doing something beyond the benchmark. For international, it could just be a simple ETF. I just want a fund that will give me developed markets exposure. मुझे और कुछ नहीं चाहिए. For gold, it could be I just want the lowest cost exposure. Hold 2 to 3 funds in each of the categories, and your problem ends there. And the fifth part of the process, which is the most important and which is all art, is trust the process and have your clients trust the process. You'll hear speeches that tempt you to move away from your asset allocation. You'll read papers that tempt you. You'll have media around. Stick to the asset allocation. Have conviction in what you're doing. My third story is a brief story where I want to end this. So I'm a 15-day-old MF CEO. And I realized over the last 15 days that one of the most common questions you get is, what is your view on RIA? What is your view on Robo Advisors? Do you think advisors are going to become obsolete? I think this topic has been discussed and we've seen many great perspectives. I don't think an advisor who's doing value-add asset allocation to his clients can ever become obsolete. Asset allocation is a deeply personal experience that an advisor can gauge. If you go back to my example in 2008, it's a deeply personal conversation with me to figure out I needed liquidity to move back to India. I'm married to someone in financial services. This is the kind of risk appetite I have. That's not a conversation a robot can do. That's a conversation an individual advisor can do. And that is putting power back in your hands as an advisor. When you sell a fund, it is a transaction. When you guide someone through their asset allocation process, it's an experience. You're choosing asset classes. You're then deciding a based allocation based on his risk-return profile. You're using market conditions to vary that allocation. You're following funds. You've got gut and gumption, and you're sticking through cycles. When you do things that are transactions, they have a price. That price can be negotiated down to rock bottom. When you convert the process of advisory into an experience has value, and it's very hard to put a price on value. Value is pretty priceless. Thank you.
Thank you, Radhika, for that fantastic presentation. Thanks for sharing your time and your thoughts here with us. Up next, we have a Twitter wall first. We'd like to take a look at some of the thoughts and opinions that you've shared with us.
Fantastic.
So I urge you all to continue doing the same. And can we take one question for Radhika from the audience? Yeah, right here.
So, what is my opinion? I don't think you can hear me.
Yeah, your voice is clear.
Okay, great. What is my opinion on arbitrage funds? I think it's a very important asset class, but you have to think, and I don't care what the MF industry says or where it's classified, as arbitrage funds as a liquid plus substitute. If you put it in that category, it's very, very valuable because today arbitrage funds give you a higher post-tax yield for that part of your asset allocation. So for the liquid and liquid plus part of your asset allocation, today the yield on arbitrage funds beats liquid funds. So I think it's a very, very important part. When we used to do asset allocation, my erstwhile forefront cap business, we used arbitrage funds in our liquid allocation. As I said, it would qualify in your liquid allocation. It's a good substitute in the fixed income and short-term fixed income allocation.
Not as an alternative asset class.
No, it's not an alternative asset class. It is an asset class that gives you month-on-month steady returns. And I think we have to condition ourselves, and I tell my sales team a lot, to talk about this as a liquid plus replacement, because that is the nature of arbitrage returns.
And what is the risk you see as your experience in 2008 of USA see in that fund sector?
In the arbitrage fund category, what is the risk I see in arbitrage funds? Arbitrage funds, you know the month-on-month yield. The risk in arbitrage funds is that yield goes down because arbitrage opportunities go away. You won't have capital losses over 3-month periods in arbitrage funds.